All right, I'm going to get started. I'm going to make this a quick video so you guys can have something to go off of when you're looking at the final exam review. I think we've done pretty good. A lot of people are doing fairly well in the class, and you guys were able to uh, perform a lot of the work and do the calculations on Excel and or handwritten. So good job, everybody. And this is the first time this class has been taught online. So I hope that you guys were able to get the knowledge you needed from it. And I hope that you guys will be able to use this when you are in your jobs. So let's get right to it, because I know you guys all have finals through all of your classes. So this is chapter 10. There's a homework assignment due. It was due yesterday, that's second, but I extended that until December 9th, and it's now extra credit. So if you do attempt that, I will give you extra credit points. And this is the video that'll go over some of the things that you'll need to do. And reading the chapter is a big help, and it'll help you understand how to build your problem and how to read some of the depreciation schedules, because the depreciation schedule is probably the hardest part of this exercise, because you're able to, it's not straight line, it's different every year when you use the MACRS, the MACRS schedules. So I'll just keep going. We'll describe relevant cash flows, identify relevant cash flows. So are we going to replace, or are we going to expand? So that's kind of what we want to know. And that's based on the state of your current equipment that you've spent money on already versus increased productivity with new or used equipment that you're replacing it with. All right. Riskiness of capital budgeting is kind of, we've been working on this all semester, so you're able to do, with more risk comes more premium. So yes, you'll get paid more if the project is completed. So there's a lot of stipulation that you have to keep in mind when you're working with financial management decisions. Describe how capital budgeting decisions differ from foreign operations or domestic operations. So we won't get too deep into this. I don't want to go too far into the chapter, but exchange rates will come into play then. So estimating cash flow, the most important and most difficult step in the analysis of capital project is forecasting future cash flow. So you have a certain amount of information, and we've been going over this more in chapter 6, 7, 9, and now this chapter, but you have to go off of the information that's available. So if you estimate that either the interest rate or the coupon, the bond payments will remain the same, or if a dividend will increase over time, you're going to have to work with what information is given. So when you're a financial staffer, you're going to coordinate with other departments because everybody's spending money and you need to know how much. Ensure that everyone uses the same economic assumptions. So that means that one department doesn't have a higher weight on the same dollar than another department. Making sure that there's no biases or inherent in the forecast. So that's taking out, like confirmation bias, like this always happens, so we're gonna include that in there. So no, you have to eliminate biases from the actual calculation there. So cash flows versus accounting income, evaluate only after-tax cash flows. And this has been a familiar theme. We always to get what you keep, you have 1 minus the tax rate, and you multiply by that multiplier. So 1 minus whatever the tax rate is, and that's what you keep. Incremental cash flows. Evaluate only cash flows that change in the capital budgeting project if the project is purchased. So this is going to be, contingencies. So you want to do a number of we call them sensitivity analyses, so that you're able to calculate in more than one project at a time, but it's all kind of in a test kind of formula. So that's before you actually make the purchase. On average, through the estimates that you're getting your information from, that will tell you where the financial vehicle is going into the future. Calculate that in with your current bottom line, and you'll be able to see if one will bump you up further than another. Is the change in the firm's net cash flow increase or decrease associated with purchasing an investment? So assets are going to be creating either increased productivity or cash flow itself, or there's other multipliers that can lead to increased productivity, but you want to keep it to those two, basically, productivity and cash flow itself through asset purchases, because buying a financial vehicle is an asset, and that doesn't really help with productivity, but it does increase your cash flow. Problems in determining incremental cash flow. So sunk costs is something that you cannot recover. It means it's gone. So sunk cost is already gone. You spent that money to either lay the foundation or work in some kind of peripheral way to make sure that either something is functioning the way it should, like an assessment by an appraiser is a sunk cost. Paying legal fees is a sunk cost. Opportunity cost is the return to the best alternative use of an asset. So this is saying it's not just accounting costs. So it's not just revenues minus expenses. It's revenues minus expenses minus what you gave up to do what you did. So you always have to include in that opportunity cost, which is usually, I'm choosing this project over this project because this project will give me a higher return. So I have to also subtract that other return from the other project that I declined in this opportunity cost assessment. Externalities. The best way to think about externalities are a third party that's affected either positively or negatively by a transaction between two other parties. All right. Shipping and installation costs are always part of the depreciable base. So keep that in mind. You can depreciate those costs. And then inflation always eats at your purchasing power. Identifying incremental cash flows. Your initial investment outlay is going to be your purchase price. Add in your shipping and installation costs, and then tax effect of selling the old asset. So if there's a replacement decision versus an expansion decision, you're going to want to add in that tax also at the end. And then change in investment working capital. So this one isn't always straightforward, but we'll see a few examples work through in the slides here. So identifying incremental cash flows continued. Supplemental operating cash flows. So changes in cash flows that are sustained throughout the life of an asset. The cash flows affect are ongoing. So we have net sales, and change in net sales is depicted by a delta, so a triangle. And then you'll have change in salaries or other operating expenses and change in taxes. So those are operating cash flows. Terminal cash flows are at the end of the project. So the salvage value, tax effect of salvaging, change in net working capital, again, that's always after a decision has been made to either replace or expand. And then lost opportunity to salvage a replaced asset. So this is your replacement decision, which says if I am, I'll just show you a numbers example. That'll be easier to explain. Here's the calculation you want to look for. And sometimes when you do this a lot, you can, just like algebra, you can leave a little bit of it out, but just for doing it the long way, long division kind of thing, this is where you want to be when you are calculating supplemental operating cash flow. So NOI is the change in net operating income, depreciation is the change in depreciation, and T is the tax rate. So right here, sometimes you can leave the depreciation out of this example, and I'll show you an example later on. But for, just to be safe, always add in your depreciation, because that's what you learned in accounting, so always add it back in. All right, so now expansion and replacement specific. Expansion project decision as to whether to add a project that is intended to increase sales, provides growth to the firm, so that's productivity. So you're like, do we want to add in another machine, or do we want to build another manufacturing facility? So those are the type of decisions. Replacement analysis is a decision whether to replace an existing still productive asset with a new asset to maintain existing operations. So that's saying we have a machine that's fully depreciated. It's still producing, but if we were to replace it with a new machine, what are the effects of that? So would our bottom line increase over the life of the machine? That's the question you want to ask, versus keeping an old machine, which tends to not increase productivity, and eventually maintenance costs will decrease the productivity. So that's more advanced, but we'll just keep it to introductory phase at this point. Purchase, so this would be an expansion. So this expansion project example. So we have HEP project is purchase price of 9,500, but if you see this means thousands. So if there's 9,500 thousands, that's 9.5 million. All right. And then shipping and installation costs 500. So these two together, the top two, purchase price plus shipping and installation, is your depreciable base. Increase in net working capital. So that's this is a net decrease of 4,000. So that'd be 4 million. Estimated life of 4 years. Salvage value is 2,000. Increase in net sales would lead to an increase of 30,000 or 30 million. Variable cost ratio is 60%. So you're always going to multiply your net sales by your variable cost ratio to get your variable costs. Increase in overhead. So excluding depreciation, so you didn't add back in the depreciation, you're going to be down 5,000. Marginal tax of 40%. And then depreciation method, 5-year MACRs. So if you go to your book on page 205, you'll see a schedule here for MACRs. So the 5-year schedule is the first year 20%, next year 32%, next year 19%, next year 12%, next year 11%. And then if it has a life that's 6 years, then you would go the last percentage points there. But what we see is this is the classification. So if we have a 5-year, that means we're dealing with an automobile, light duty truck, computers, office machinery, certain special manufacturing equipment. So they're all classified, and this is federal law. And actually, it was changed. A few of these were changed when President Trump was elected, but we'll stick with this for again, to be safe and to learn how to do these calculations. So this is the schedule we're looking off of, and this is the year ownership. All right. So 5-year. And now so this is the initial investment outlay. So the change in net working capital. The shipping and installation purchase price is going to be $14,000. So always look for the triangle here. So net sales 30,000. Variable cost is your variable cost ratio times your net sales. So that's 18,000 variable cost. Fixed costs excluding depreciation is your increase in overhead. So that's
actually it's not on the doorbuster today.
I'm going to flip back and forth a bunch of times. And
I'll find something I want.
Operating.
I'm gonna figure out what I want that's on sale for her to buy me.
Cash flow before depreciation and taxes is 7,000. So that's saying 30,000 to start, take away 18, then take away 5, you got 7 left. And then this operating cash flow is going to be the number that you, well, we'll just keep on going. So this is a comprehensive kind of cash flow model. So just review the video and email me if you have any questions. But I've made all of these questions on the final exam and the homework extra credit. So no problem if you don't do it. All right, so depreciable base is going to be your purchase price plus your shipping and installation. And then again, the MACRS rate, this was a 5-year schedule. So 20, 32, 19, 12. And again, it said it had a 4-year life. So you only go the amount of years. So it's a 5-year schedule, but it only has a life to 4 years. So you only go this deep into the schedule. So 20, 32, 19, and 12. So going to the actual table here. And then this would be what your Excel would look like here to be able to calculate depreciation. So first year 20, second year 32, third year 19, fourth year 12. And then you multiply the depreciable base by these depreciation factors, and then you get this. For annual depreciation, you add them all up. And then you keep this as your accumulated depreciation figure, which will be brought up later. All right, so the selling price of the asset after the useful life is your salvage cost. I mean, your salvage value. So it was a $2,000 salvage value. And this is all from this table here. So salvage 2,000. Taxes on sale of the asset. So that's, let's see here. Tax rate was 40%. Marginal tax rate is 40%. And then you multiply your salvage by 1 minus the tax rate. It's always what you keep. So 60% times 2,000. I mean, yeah, let's see here. Oh, my bad, tax on gain. So that's right. When you're doing a salvage, you always take the difference between your salvage price and the book value. And then you can only be taxed on the difference there. So book value of an asset is your depreciable base minus your accumulated depreciation. So that we did in the previous two slides. And then your salvage value minus your book value is 300. And you multiply the tax rate by the gain. And then sometimes it's negative, so you could be owed taxes. So scratch that last part. You do not do 1 minus the tax rate on the sale of your asset. You do that in this part right here. So that's your net operating income, which was again the 30,000 minus the 18,000 minus the 5,000, and then you 1 minus the tax rate there. And then these are your depreciation values, and then you add in plus that's this end part of the equation here, your tax rate times the change in depreciation. So this formula right here does not add in depreciation on the front end because the 7,000 excludes depreciation. So this is from this calculation here. So excluding depreciation. All right. And then this is the supplemental operating cash flow that you'll get for each year. And then that's that one. All right. And then this is kind of a timeline over time. And you start out with your initial investment outlay of 14. And then you have operating cash flow, which are these guys that you add in over the years. Terminal cash flow is this calculation here, which was again, tax on the gain would equal 120. So you have to pay that much. And that's the only negative that comes out of the 6,000 here. And then this is total. So over time, each year, this is how much you're going to be looking at. So you spend 14,000 in the beginning, then you get 5, 40, 54, 80, 49, 60, and 10, 56. And the last one would usually always be, the last year will usually always be bigger because you're getting, if you're replacing or if you're selling. So that's the question you gotta look to when you're looking at the homework in the final. This is a timeline, and then this is discounted payback and regular payback. So how many years would it take to get back to your 14,000? And then you can also calculate net present value out of these figures. With a stated rate. So always remember you're looking for an interest rate. Project is acceptable because net present value is greater than 0. So we always want to use net present value as trump even above internal rate of return and modified internal rate of return. Now here's a replacement project. You always have to have old figures and new figures. And then, so you run through the same process that we just went through in the slides here to get to these figures. And then we have our, so purchase price. And I don't see anything about installation or shipping. So then get to the book value, accumulated depreciation, 10 times 500. So depreciation method 500, that means straight line if it's just a figure. But the new machine is 3-year Mackers, so that's going to be, let's see, that's going to be this one. And then this is for the old project. And this is for the price of new machine. So the new machine net working capital, net cash flow from the sale of the old machine. So this is your initial investment outlay. That would be from replacing the new machine. I mean, replacing the old machine with the new machine. So looking at it in a table form, you have your initial investment outlay times, so your depreciable base times the actual interest, I mean the Mackers rate. So that's 33, 45, 15, and 7. 33, 45, 15, and 7. And then it has a useful life that's longer than 3 years. So longer than 4 years that are in the 3-year schedule. So 3-year schedule goes on for 4 years, but if it's got a useful life of 5, 6, 7 years, each one of these is going to be a 0 afterwards. So you don't have to pay any depreciation. I mean, there isn't any more depreciation after it's fully depreciated. So this is a comparison of new and old machine. So 36, 54, 18, 840. And then the change in depreciation is what you want to calculate. So the other one was straight line 500 each year. And then the new machine is depreciated like this. So what you have is 3960 minus 500 equals, and then down here 0 minus 500 equals negative 500. And then you use these change in depreciation as the form. Remember that formula? That's net operating income plus depreciation times 1 minus the tax rate plus tax times your change in depreciation. So that formula is all the way back up here. This one right here. And then you get your supplemental operating cash flow numbers, which then you do your analysis with those. So if HEP buys the new machine, the old lathe will be sold today. If HEP sells the old lathe today, the company will not be able to sell it for its $400 salvage value in 2024, which means HEP will not receive $400 in 2024. Okay, so that's part of this. All right, so the old machine will not, because it's not fully depreciated. It has to be fully depreciated to get to the salvage point. If not, then you can sell it on the used market. This is relevant because the loss of the $400 salvage value results from the decision to purchase the new machine. Oh, my bad. Yeah. So if you're not able to get the salvage value when you do the replacement, then you have to calculate that into the final decision. Thus, the $400 should be recognized as an outflow because you're losing that money in 2024. Book value of new machine in 2024 is 0 because it will be fully depreciated. Gain on the sales of the new machine is 2,000 minus 0. Tax on the sale is 2,000 times 40%, 800. So you get to keep 1,200 of that. For the sale of the new machine in 2024. And then this is terminal cash flow. So we calculate the loss of the salvage value from the old machine into this calculation. So 1,200 plus 1,400 minus 400 is 2,200. Here's the investment outlay, supplemental operating cash flows, terminal cash flow, which is the end here, always going to be the last year, net cash value. So we have 11,280 original investment outlay. Then we're making these are the supplemental operating cash flows. And then the last one includes the terminal cash flow on top. So then we use these numbers to calculate net present value, internal rate of return, and everything that we've worked on before. So HEP's replacement project is not acceptable because net present value is less than 0, which is right here. And IRR is less than 15%, 14.46. So the payback period is going to be greater than the useful life. And that's when we say we don't want that because we're still paying on something that we can't use anymore, then our bottom line is going to go down. Incorporating risk and capital budgeting analysis. Project risk should be evaluated to determine whether an appropriate required rate of return is used to compute the project net present value or compare it to IRR. And so that's saying the more risk, the higher the rate. If a firm is considering a project that is much riskier than the existing assets, then it makes sense for the firm to expect to earn a higher return on the project than on its existing assets. So another way of saying that is the more risk, the higher the return, the higher the rate. The required rate of return. So that's going to be your what your firm's portfolio will let you know what kind of return you need to get an increase in your bottom line. Standalone risk is risk of an asset when it is held in isolation, that is when it stands alone. And that's going to be something that's not going to change its productivity over time. Corporate or within a firm risk, how an asset will affect the firm's total risk if it's purchased and added to existing assets. That's what you're going to see the most of. And that's kind of what I've been trying to explain the entire course here is you use what you already have and then you calculate the risk of adding in something new. Beta or market risk, how an asset will affect the firm's market risk or beta if it is purchased and added to existing assets. So this is saying so this is kind of external to the firm. And this is saying how the industry as a whole is reacting to your purchase of that asset. So in a real world example of that would be like when Tesla Motors bought, what's the name of the company? Solar City, I think it might be. Back in 2016, I believe it was. And then they incorporated Solar City's assets into Tesla. It was Tesla Motors before, but now it's Tesla um, in general. And they were able to acquire the company with stock, but the company wasn't profitable for them because they were installing solar panels on houses without any down payment and just a strict monthly subscription kind of platform, which they have again now, but now they can afford to do that. Where Tesla is now being accused of bailing out Solar City, and they are they being Securities and Exchange Committee and actual stockholders of Tesla are saying this deal didn't go down right. It was kind of a keep it in the family kind of thing with the Musk family. So now we're just starting to see now, was that asset really a blooming asset or was it toxic? So we'll see how that works out. Sorry, that was long-winded. Techniques for measuring standalone risk. Key variables are changed and the resulting changes in the NPV and IRR are observed. So deviation from base case, percent. So if it's a 10% change, operating expense savings per year, net present value is negative 421. Operating expenses per year percent change is negative 237%. Required rate of return. This is not supposed to be dollar sign. These are percentages here. So that's saying we need this is right. Let's see here. 519%. That seems high. Operating expenses show greater sensitivity than the required rate of return. Okay, so operating expenses show greater sensitivity than required rate of return. All right, so don't worry about this part right now. I'm having a brain freeze, and I'm not. I'll come back to it if it comes to mind. But I'm thinking, this is what. Okay, come back if I can remember that. And this is kind of the same. This is advanced right here. So coefficient variation is going to be your kind of statistical analysis of whether or not your projection into the future is going to be close to what it really will be. And we're looking at using net savings, your net present value, profitability, quotient, and your net present value times your profitability quotient is going to be, kind of the numbers that we're going to compare to. So you can get a range of possibilities. So you got your best case, base case, and worst case. So, and then you have to create these yourself and create a statistical analysis of it to be able to argue that if we are able to create X amount of productivity, then we can expect to be here. And this is kind of the whole gist of being a financial manager is being able to take your company higher based on an analysis of your firm's assets and capability. Compare its coefficient of variation to the coefficient of variation of an average risk project. And to do that, you can look those up. Those are kind of your base case. Okay, so tries to simulate real world by identifying all the possible outcomes of the situation or variables. They are associated with capital budgeting project along with the probabilities that these outcomes will occur. So that's your statistical analysis, and these are your probabilities. And the probabilities should always add up to 100%. So it's 20% that will get to the best case, 70% that will get to the base case, and 1% that, 10% that will get to the worst case. So this is you doing this. You know, you can get yourself a template to work with, but make sure that you're practicing these skills a lot. And in economics and statistics specifically, you work a lot with probability and coefficients. So this is now within firm risk. So that other one was standalone. So that's saying this is over time, they're not going to increase or decrease productivity. So your standalone risk is set it and forget it. And this is best case, worst case, and base case. All right, within firm, determine how a capital budgeting project is related to the existing assets of the firm. If the firm wants to diversify, it'll try to invest in projects that are negatively related to the existing assets. So that means that if one, like if you're buying stocks and bonds, stocks specifically is a good example here. If one stock's going up due to some economic, nudge, then another stock would go down at that same time. So you'd want to evaluate that stock that's going down based on its, dividend, year-over-year change in stock price, and whether or not the calculation over a certain amount of years would add to your bottom line. If the firm can reduce its overall risk, it generally becomes more stable and its required rate of return decreases. And that's per thing that you're going to buy, per project or financial vehicle. So depending on whether or not you want to be diversified, and you're always going to have this range of possible things that you can engage in. So when the risk goes down, the certainty goes up, meaning that I'm quite certain that we can get the business up to this point by following this path. Beta or market risk. So theoretically, an asset has beta or some way to measure the systemic risk. And beta this is a regression here. So this is really advanced stuff, and I'm just going to cover it real quick so you guys have an idea, but the questions won't go that far. If we can determine the beta of an asset, then we can use this capital asset pricing model, CAPM, to compute its required rate of return as follows. Return from the project equals the risk-free rate plus your rate for project M minus the risk-free rate times your beta of the project. So the beta is kind of the, it's not the unknown, but it's the variable that you're testing if it will increase or decrease your bottom line or your performance or your productivity. So measuring beta risk for the project is a default. pure play method, identify companies whose only business is the project in question. So that's a set it and forget it. So capital budgeting project characteristics, if the cost is 100,000, beta of the project is going to be 1.5. This is all determined through your variable analysis and your statistical analysis and probability analysis. Risk-free rate is 3%. Your required rate of return is 9%. If the rate on the project is 9%. So the rate on the project is 3% plus 9 minus 3% times your beta. So that's going back to this formula right here. Equals 12%. So the required rate of return is 12%. And the rate that's measuring beta. Oh, I'm forgetting what the subscript M is. All right. Well, this is neither here nor there. This is just you can look forward to some of these variables in the future. So actually, I think we're getting to the point where we're not going to need to know this part, because the questions that I have in the homework and in the final exam, which I'll go over now, don't get this deep into the PowerPoint. So I kind of got carried away there. But to conclude this, I'll go through these slides real quick. Excuse me. So the firm's characteristics before purchasing the project: total assets of 400,000. The beta is 1.0. The beta coefficient after purchasing the project. So beta of the firm minus the new project is 1.0, 400,000 over 500,000 plus 1.5, 100,000 over 500,000. So that's this cost, and then the total assets. And then total assets for after purchasing the project are going to be adding these two together, because you're adding $100,000 worth of assets in. So your coefficient after is going to be total assets after are going to be 500,000. Most firms use adjusted discount rate. The risk-adjusted rate is equal to the risk-free rate of the interest plus the risk premium. And you can go over those again in chapter 6, where we went over bonds. You have the 4 different types of premiums. The average required rate of return for projects with above average or below average risk, for example. So if the higher the risk, the higher the return. That's the takeaway there. Capital budgeting projects of multinational firms should be evaluated same as domestic. And then you want to include translation of foreign currency into domestic. That's your exchange rate. And then a government might take over. So that we've seen with some oil and automobile companies in Venezuela. And there are other examples of things like this. So keep in mind that you might have to write something off that's an entire factory and all those workers. And it just becomes an unproductive asset. All right, so real quick to cover the exam. Let's see here. Modules. All right, so the first 7 questions will be worth 2 points each. Short answer, just multiple choice, true and false. Um, you know, definitions. So that'll be, finding the bolded words that are in the chapter and they give the definition on the side. And then this is from chapter 6 all the way through chapter 9. So 6, 7, and 9 really is what we're covering. And then moving down 8, 9, 10, and 11 are going to be Excel spreadsheet questions, and you can watch the videos from chapter 6 and chapter 7 and chapter 9 to see how to do these. I'm going to require an Excel spreadsheet for those. And then these last 2 questions here are extra credit worth 2.5 points apiece. And that's 2 questions that'll cover kind of what we went over tonight. And that's just, page 184 in the 5th edition and page 205 in the 6th edition. We'll give you the Macker's schedule so you know how much depreciation to take away. All right, and then I think that's all I wanted to cover for today. So this will become available on Friday night, and then you'll have I'll put a deadline. Let's see what deadline we have here. We have due December 12th. So Thursday, December 12th, the final exam will be due. Case studies are due on Friday, and I'm going to put up a discussion question right after this, and that should be good for the semester. So don't worry too much about week 14 assignment. I've changed it to extra credit because as you can see from the slides tonight, that the material is advanced, intermediate to advanced, going towards the end there. So email me if you do want to go through it and if you have any questions on it. And yeah, I hope you guys had a great semester, and I'll do one-on-ones if you need them, and get a hold of me if you guys need any help with any of the homework questions, not the exam questions. All right, any questions from any of you guys? All right, then, you have a good night. I'm going to stop.